Well, hey, and welcome back. Brett Hirsch here, instructor for overnight accountant, owner of realestatetexpros.com, and once again, I would like to welcome you back to our series, our little mini-series on how Congress is killing the tax profession. Where we're at right now is we are in part 2, the impact it is having on the tax profession. I know when you're killing something, you're probably having an impact on it. So let's look into what this impact is. We're looking at the results of Congress's activity. And of course, this has a cause and effect because 1040's primary function has changed, as you learned in part 1. So has the tax profession. It has changed greatly. Discussion points in this particular lesson, or part 2 of our little series, we're going to be discussing social workers and fraud auditors. That's what we become. You're going to talk about shrinking supply and increasing demand for the services of tax professionals. And you're also going to follow up with April 15th is just stupid. Just stupid anymore. Due to the reasons I discussed earlier in part 1. So, I digress. Let us proceed, shall we? All right, we're social workers. Tax professionals have now become social workers. Many of these credits represent social welfare programs. I discussed them earlier. Each recipient must qualify for these programs. Numerous different criteria for each credit exist, which we're responsible for all of those. Tax professionals administrate each one of these programs. And it's not just about social welfare. There's a lot of other items that happens in there. We may discuss those in this lesson. I can't remember, but you got your industry impact, manufacturer rebates, foreign policies ran through your tax code. So what happens when free money gets disbursed on these tax returns? Lots and lots of fraud. How much fraud? Let's take a look. So let me back up a little bit. When you're running all these social programs through a tax return without little oversight, really, other than tax professionals being responsible for it, you have lots and lots of potential fraud taking place because tax pros aren't filling out all these returns. Not all of them. You have a lot of individuals that do taxes, and you have a lot of individuals that do their own taxes. Or prepare their own tax returns. As a result, there's a lot of errors and a lot of fraud. Let's look into this a little bit. Remember I discussed the earned income credit earlier in part 1? Well, that distributes over $65 billion, if you remember, to over 26 million recipients each year. $65 billion, hey, that might be a lot of money. I think it is. Government obviously doesn't think it is, but I think it's a lot of money. And the IRS estimates that 20 to 26% of that $65 billion are either sent out erroneously because of errors, and I think that's a small portion, errors, or fraud, straight up people stealing, getting the credit that they're not responsible for, and it is facilitated by some individuals and companies. It's, I don't want to get into that too much, but that's a lot of money. How much money is it? That's $14 to $17 billion per year lost of your tax dollars lost to the earned income credit. And this is just one example. All those credits I discussed in part 1, they all have very similar issues, but this is the biggest culprit right here. This has made tax professionals one thing. We are now fraud auditors. Who's responsible to making sure these credits are really, to people getting them, actually deserve them, they qualify for these credits? Who's responsible for that? Tax professionals are. Each year, we must verify more information and complete more and more forms to make sure. It's called due diligence, and it is tax returns take twice as long to complete now as they used to, largely due to due diligence and just complexity. What does this have to do? What does this have to do with taxation, or our training as accountants, our training as tax professionals, our training in taxation that we learned in school? What does this actually have to do with accounting and taxation? Less and less every year. But what does it do? It does increase the risk, the cost, and the time of completing each tax return. So it has a cost, obviously not just fraud, but dealing with that fraud, which tax professionals are responsible for, it takes a toll. It takes a big toll in terms of time, money, and just, as I said, mind-bending complexity. How is this increasing complexity and changing function impacting tax professionals, the tax profession? Basic returns, I mentioned a minute ago, basic tax return takes twice as long, as it used to 5-6 years ago, even just 5-6 years ago. It's getting ridiculous. This ends up being high stress and a health hazard, because preparing tax returns when you have several hundred clients all wanting their taxes done, all delivering their materials at roughly the same time, it can be highly stressful, and it can also be a health hazard because stress just isn't good for you. People are dying at their desks. I don't want to be one of them. That's why I'm such an advocate for the tax professionals. Pros are retiring, they're quitting, they're changing professions. You know, if someone has an accounting degree, they don't have to go into taxes. If they know taxes, they don't have to do public taxation. They can move on to something else. And that is creating what? A shortage of supply. 75% of CPAs in the United States, according to AICPA, reached retirement age in 2020. That's a lot of professionals leaving. And many of them are just quitting. As soon as they can retire or afford to retire, many of them are. Not all of them, but many, many of them. It's an aging population, and we are not replacing ourselves. Like certain industries, just in general, there's a large shortage or a decrease in individuals getting accounting degrees. Maybe it's not as sexy as it used to be. You can make good money in accounting, but there's been roughly, and there's different stats will show different things, but 20% decline in the number of accounting majors across the United States. That might be a little high, but it's significant, whatever that number is. And if you graduate with an accounting degree, or if you become a CPA, you can do all kinds of stuff. You do not have to deal with taxes. It's a broad industry. So it's creating a very big shortage of tax professionals. At the same time, what else is happening? You got increased demand. You know, fewer individuals can prepare their own returns properly. That's not saying they're not trying, but they're getting hammered when they get looked at by the IRS because this stuff is complicated. Filling out a little, on a screen, going through a little interview and thinking you get it right all the time. No, you don't. You don't. Retail chains are no better. I mean, you get all these retail chains, but they're dealing with the same stuff we are. A very small percentage of these folks are really, really highly trained. Some of them are, don't get me wrong, but think about it. It's a seasonal work, very demanding, very complex. A lot of them know nothing more than how to put a form into a screen. That has nothing to do with tax code. And then they hope the software handles it for them. Guess what? It doesn't. It doesn't. All right, so what do you got? You got high demand and low supply. What does that mean? That means two things. It takes longer to prepare returns, longer wait to get your taxes done, and also supply and demand, equilibrium, market clears, where cost equals quantity demand and supply. That determines price. So you're dealing with higher prices. Finally, this brings me to part C of this particular segment. April 15th is just, well, stupid. Just stupid. All right, let's discuss April 15th a little bit, shall we? April 15th, 1955. Let's go back to 1955. That's when April 15th was created. It used to be March 15th. This has been our deadline for roughly 70 years. It has been our deadline for tax returns. April 15th. You know what else? Before then it was March 15th, before 1955. In 1955, let us say, the entire return, the entire tax return, itemized deductions, all your exemptions, everything on that tax return was 4 pages long. There were 2 credits. I believe one was for retirement and one might have been for certain dividends. That's all there was. Entire return was 4 pages. Plus you had a Schedule C for sole proprietors, all right, and then you had a Schedule F for farmers. That's it. That's the entire return. As I said earlier, 2 credits, dividends, and room was related to retirement. So why April 15th? There's many reasons for April 15th. Everybody paper filed returns. We had a massive debt from World War II. The United States did. Income and taxes were increasing, so incomes were rising as the taxes were increasing and more people were becoming subject to the tax, because in the beginning it was only for that rich people when they created the income tax, only for that rich people, make them pay their fair share. We've all heard that. But more and more people were becoming subject to the income tax. Regular people were now filling this form out. They had to. More were filing returns, paper returns, so the IRS had more stuff to deal with and became more and more complex to a certain extent for them to deal with. But this is mainly the reason it was turned to April 15th. From 1040 had just become too dang gone complex for individuals to complete on their own by March 15th. So they created April 15th, which is what we have now. And I want to say why April 15th, because that applies a lot more now than it did then. That's why I worded this slide this way. All right, so what do we got today? We have over 20 22 forms that are commonly attached to your Form 1040. And you got statements, underlying statements, over 70 of those. Well, 70-ish. Let's say 70-ish is what I got up there. Let's stick with that. Pros must understand each of these forms, and we have to use each of these forms quite often, and we have to attach them when they are required for the return, or to the return. But now you got third-party reporting. You knew all the 1099-Bs, 1099s INT, 1099-Ds, 1099-NECs, 1099-Ks, 1099-S. That's just a few. All these different 1099s are what's called information reporting forms. So is your W-2. And these have just become nuts. And you just don't, like 1099-B broker statements, your dividend is interest. A lot of people have investment accounts, and you expect these brokerage houses to have correct information to you by the end of January or even February 15th. It's impossible. A lot of folks, and then you have partnerships, publicly traded partnerships that file extensions. Most individuals with any kind of tax return do not receive their information until at least mid-March. And then they compile it, whatever, it's mid-March. So what's that mean? Many of the forms, as I said a minute ago, they receive them and they're wrong. Those brokerage statements I mentioned a minute ago, they're complex. So later, like June-ish, you might receive the corrected forms from those brokerage statements, often after you filed your returns because you had to get it done by April 15th. Now, April 1st, in our industry, people receiving their information in mid-March, and then by April 1st, we get nothing done but file extensions. So you pretty much got a 2 to 3 week window to do a year's worth of work. It can't be done. So, to summarize, April 15th is just, well, stupid. What would it be now if you based it on the same thing? We do it by the pound. Should it be June 15th, July 15th, July 15th the following year? If we're basing it on complexity, that's something we should think about. All right, so that's the end of part 2. Thank you for viewing. Part 2 of how Congress is killing the tax profession. And thank you so much, and I'll see you in the next lesson.